They stalled until the absolute last second. Thin volume, books closing, zero depth. Then on the year's final trading session, they smashed the price. If you watch the charts today, you didn't see a simple pullback. You witnessed a bloodbath. Silver plunging from the peaks. Profits wiped out in hours. Faith rattled right before the calendar turns. For many stackers, it felt personal. You held through the chop. You thought the breakout was legit, and now right before the new year, your holdings are in the red. But here's the reality most folks ignore during moments like this. What you are seeing is not the death of a bull run. It isn't a fundamental failure. It's a forced liquidity crunch. A mechanical dump driven by algos, not truth. A dash for cash that occurs every single year, yet only burns those who don't comprehend the rigged game. December 31st isn't a trading day for the banks. It is an accounting day. At midnight, the regulators snap a photo of every big balance sheet. That picture decides capital requirements, risks, scores, and fines for the coming year. Hold too many volatile plays, and the cost is billions. The fix is easy. Dump it all. Gold, silver, equities, bonds. Turn risk into cash. Cash drops the score. Cash keeps the regulators off their backs. So when you spot huge red candles in a thin holiday market, don't mistake it for panic. This isn't stackers losing hope. This is big banks scrubbing their books, dumping lots into low liquidity to window dress the balance sheets one final time. It feels brutal because it is concentrated. It feels rigged because it absolutely is. This is the final washout, the last shakeout before the reset, and if you get what is going on, it's not a reason to be scared. It is a sign that the pressure is fleeting, the trend is solid, and the setup for January is already in the works. Don't let them steal your stack. If this breakdown helps you chill while others panic, type 1 in the comments now. If you want the true scoop on market moves like this, subscribe now so you won't miss what is coming next. To get why silver crashed today, you must step inside the head of a banker on December 31st. This isn't a day driven by belief forecasts or long-term plays. It is driven by the fear of digits on a spreadsheet. At midnight, regulators freeze the frame. Whatever assets sit on the books at that precise moment define the bank's risk profile for the entire year ahead. This single snapshot sets capital buffers, systemic risk ratings, and regulatory fines. If a bank is holding volatile assets when that picture is taken, its risk score jumps. When that score rises, the penalty is immediate and brutal. More capital must be set aside. Less leverage is permitted. Profits are slashed. Careers are questioned. So the choice isn't philosophical, it is mechanical. You dump first and ask questions later. Precious metals are among the first to go, not because they're weak, but because they're liquid. Gold and silver can be swapped for cash instantly. Cash is the sole asset that drops risk scores without any debate. That's why silver, gold, bonds, and stocks all drop together in moments like this. It isn't a judgment on value. It is a scramble for balance sheet survival. Banks aren't trading. They are evacuating, and they're doing it in the thinnest market of the year when every sell order carries exaggerated force. This is why the move feels huge. A few thousand contracts dumped into a holiday market can shift price levels that usually take weeks. Algos amplify the move. Stops get triggered. Momentum traders bail. What started as accounting turns into apparent chaos on the charts. But this chaos is on a timer. Once midnight hits, the rule no longer applies. The photo is snapped. The pressure lifts. The same banks that sold to survive December are free to buy again in January. This is why these crashes feel sudden, violent, and confusing. They aren't organic. They are scheduled. You aren't watching a market decide silver's fate. You are watching banks survive a deadline, and deadlines expire. Look at the bigger picture, and the message gets clearer. This was never just about silver. Gold dumped hard, too. And when gold sneezes, silver doesn't just catch a cold, it bleeds out. Silver is a smaller, thinner, more volatile market. It amps up whatever force moves gold. A 2% move in gold can translate into an 8% swing in silver without warning. That link matters. It tells us this isn't a supply story. It isn't about demand suddenly vanishing. It is a macro liquidity event. A synchronized dump across asset classes driven by one thing, the US dollar. When banks sell assets to raise cash, the demand for dollars spikes. Not because the economy is strong, but because the system needs greenbacks fast to satisfy year-end requirements. This fake dollar shortage drives the DXY higher, and a rising dollar acts like a wrecking ball. It crushes everything priced in it. Commodities drop, metals drop, risk assets wobble. But liquidity crises are by nature temporary. The system can't work without dollars. The central bank knows this. When the strain gets visible, liquidity is injected. Repo markets open. Pressure eases. The dollar fades. And when the dollar fades, precious metals rebound with force. Right now, you're in the eye of that liquidity storm. It feels violent, because it is fast. But fast moves driven by funding stress rarely persist. They reverse when cash becomes available again. This is why gold and silver are moving in lockstep today. It confirms the cause. It also hints at the fix. When liquidity returns, both markets recover. Silver doesn't need a new story to rise. It simply needs the dollar to exhale. The trend didn't change today. The environment did, and environments shift way faster than fundamentals ever do. Now let's discuss what everyone is staring at in disbelief: the chart. A sudden drop to the low 70s isn't pretty. It breaks the short-term uptrend. It prints a massive red candle that dominates the daily chart. To tech traders, this looks like a fail. To algos, it looks like momentum. And to those who trade signals without context, it screams one word: sell. This is how secondary damage is created. The first selling was mechanical, but what followed was emotional and automated. Stops were hit, trend followers exited, short-term models flipped bearish. Each layer of selling fed the next. The move fed on itself. Right now, price is testing a critical zone. This level was resistance for weeks, the ceiling that price couldn't break. Once broken, it must be support. This is the line in the sand. If it holds, this whole collapse becomes a backtest of the breakout. Painful, sure. Invalidating, no. And here is the detail most people miss. Look at the behavior near the lows. Each time price dips into this zone, volume spikes. That is absorption. Someone is stepping in front of the selling. Someone is saying, I will take it here. That someone isn't panicking. That someone is stacking. This is how traps are built. Weak hands see a broken chart and sell in fear. Strong hands see a discount and buy with patience. The market uses technical damage to transfer assets from emotional traders to disciplined ones. This doesn't mean price can't dip further. It means that downside is being contested, not abandoned. Support is being tested, not surrendered. If this level holds, the chart will heal faster than most expect. And the very candle that scared everyone out will be the launch pad no one believed in at the bottom. Now step away from the screen, because this is where the real story reveals itself. While the paper price of silver crashed in a matter of hours, the physical market barely flinched. Dealers didn't rush to cut prices. They didn't flood the market with inventory. In fact, the opposite happened. Premiums expanded, availability tightened. The street price refused to follow the screen price down. This disconnect isn't an accident, it is a signal. If this crash reflected true weakness, if silver had genuinely lost value overnight, physical sellers would be panicking. Coin shops would be flooded with metal. Dealers would be slashing premiums just to move product. That didn't happen. Instead, premiums rose because dealers understand replacement risk. They know selling metal cheap today could mean they can't replace it tomorrow, when price snaps back up higher. This behavior tells you everything. The selling you are seeing is confined to paper markets, leverage, and contracts that can be exited with a keystroke. The physical market requires commitment, storage, transport, capital, and the physical market isn't voting bearish. Trust the market that demands delivery, not the one that settles in cash. Paper traders are emotional, physical holders are deliberate, and right now physical holders aren't selling. Now look at the industrial side. If you are a manufacturer, planning production for the year ahead today isn't chaos. It is opportunity. Lower spot prices reduce input costs. Industrial buyers do not chase momentum. They accumulate value. Their bids create an invisible floor beneath the paper price. This is how shortages accelerate. Metal leaves vaults and enters factories. Once consumed, it never returns. While paper traders dump contracts, real silver is being absorbed quietly and permanently. The chart might look broken. Sentiment might feel fragile. But underneath the noise, silver is moving from weak hands to strong ones. And that transfer is exactly how the next explosive move is built. While the retail herd focuses on the visible chart damage, the critical rig today is happening beneath the COMEX surface. To tamp silver this aggressively into year-end, the bullion banks likely had to reshort the paper market. They didn't just sell longs, they printed new paper supply. They opened fresh, naked contracts into the dip to manufacture liquidity when none really existed whatsoever. This rigging detail matters more than the spot price. Earlier in the week, the commercial traders reduced net exposure. They covered on the rip. They shed risk as the metal pushed higher. But to tamp price before the regulatory snapshot, they had to step back into the fire. New naked shorts were deployed not because silver is weak, but because they needed the tamp immediately. This wasn't confidence, it was sheer paper desperation. And desperation creates bear traps. Every paper contract sold today becomes a future obligation. Shorts don't vanish when the calendar flips. They remain open, waiting to be covered. And when liquidity returns, waiting becomes expensive. By tamping price now, the cartel bought temporary accounting relief at the cost of major future pain. This is how volatility compounds. One forced tamp sets the conditions for the next. By reloading shorts into a market where physical supply is already tight, they are building fuel for a violent reversal. When buying pressure returns in January, these shorts must compete for limited liquidity. That competition is called a massive short silver squeeze. And the exit door is smaller than before. Industrial demand has not slowed, physical inventory has not grown, stacker conviction has not disappeared. The real metal sold today is much harder to source tomorrow. They kicked the can forward, but they kicked it uphill. Time, math, and scarcity are not on their side. Market gravity always wins. This is where the calendar finally shifts in your favor. January is not just a psychological reset. It is a structural reset for capital flows. On the first trading days of the new year, fresh fiat enters the system automatically. Pension funds deploy new allocations, endowments rebalance portfolios, retirement accounts receive steady inflows. Billions of fiat dollars sidelined in December return almost all at once now. Right now, the paper market feels hollow because it is. Liquidity has been drained by regulatory pressure, tax loss selling, and risk reduction ahead of year-end. That absence of buyers is what allowed spot to fall so fast. But that emptiness cuts both ways. Once January begins, the paper sellers disappear. The accounting snapshot is done. The tax year is closed. The artificial reasons to sell evaporate overnight. The same banks that dumped assets to survive December are suddenly free to rebuild positions. And they return to a market that has been tamped unnaturally low indeed. This creates a vacuum. Buyers must raise bids to attract sellers. That is why January reversals are often sharp and emotional. The speed of the rip frequently mirrors the violence of the tamp down that preceded it here. Silver does not need a new bullish story to rip. It simply needs real capital to return. And that return is already scheduled now. This is the slingshot effect. The deeper the tamp, the more energy is stored for the launch. By forcing spot lower into year-end, the system compressed the spring. When it releases, silver can travel much further and faster than anyone really expects. Selling now is not risk management. It is capitulation at the worst possible moment. You are exiting just as structural headwinds turn into tailwinds. January is not about hope. It is about mechanics. And the mechanics reward the strong hands. Now let's talk about the emotion driving the final leg of this move, because markets don't bottom on logic. They bottom on exhaustion. What you are seeing right now is not just selling. It is capitulation. Weak hands aren't making calculated decisions. They are reacting to pain. They are selling because the tamp feels unfair, because the speed feels unnatural, because confidence has been shaken down. This emotional washout is truly necessary. When price falls hard and fast, the first wave of sellers is mechanical. Stops are triggered, algorithms respond, but the final wave is human. It is the moment when stackers throw their hands up and say the game is rigged. That anger is not a warning sign, it is a clear signal. Markets tend to bottom when frustration replaces optimism. When hope is gone, selling pressure dries up. There is no one left to panic. That is when spot price stabilizes here. Look closely at sentiment. Comment sections are filled with disbelief. accusations of manipulation, declarations that silver will never moon. This is not the voice of a top. This is the sound of emotional capital being drained out. And here is the paradox. The more convinced people become that spot cannot recover, the more likely a recovery becomes. Markets exist to inflict maximum pain. Today they punish the longs. Tomorrow they will punish the naked shorts. This is how false bottoms form. Price pauses, confidence vanishes, and then the reversal begins without warning. Those who paper-handed for emotional relief watch from the sidelines as price climbs back without them. Fear feels like information, but it is not. It is a response to volatility, and volatility is highest at key turning points. The question now is no longer whether silver will recover, but how that recovery unfolds and who will still be stacking when it happens. Recoveries are shaped by cause, not emotion. And because this tamp was driven by calendar pressure, regulatory mechanics, and forced liquidity, not by a collapse in value, the rebound is likely to be fast, sharp, and deeply unsettling. This is the classic anatomy of a V-shaped recovery indeed. When the calendar turns forced, sellers disappear almost instantly. The regulatory snapshot is complete. The tax year is closed. The artificial reasons to sell are gone. Liquidity begins to flow back into the system. What remains is a market that has been tamped below equilibrium with very few natural sellers left standing. In that environment, even moderate buying pressure can move spot far more than logic would suggest today. The first signal to watch is the open. A gap higher on strong volume is not random. It is confirmation. It tells you that buyers are willing to pay higher prices to re-enter positions they were forced out of days earlier. That move often feels sudden because it is. Markets do not ease their way out of forced selling. They snap back hard. After the initial rebound, consolidation usually follows. Spot may move sideways as the market repairs technical damage. This is not weakness, it is construction. Sideways action allows emotions to cool short positions to reassess risk and momentum to reset. It builds the base for the next impulse rally up. Then acceleration begins. Shorts start covering. The banks rebuild exposure. Momentum traders return once key levels are reclaimed. Each wave of participation reinforces the next. What felt broken just days earlier suddenly feels truly inevitable now. The most dangerous mistake at this stage is waiting for comfort. Comfort only arrives after spot has already moved. Recoveries do not reward certainty, they reward conviction when clarity is scarce today. We have reached the final chapter, and this is where perspective matters most. What you just lived through was not a failure of the thesis. It was a test of it. The year-end flush was a mechanical event designed to protect bank balance sheets, not to reveal truth. And those moments are always the most emotionally expensive because they force you to choose between fear and understanding. Here is the strategic takeaway. Markets are not moved by fairness. They are moved by incentives, rules, and timing. When you understand those forces, volatility stops looking random and starts looking useful. This crash was not an ambush. It was a scheduled transfer. Assets moved from weak hands to strong hands. That is how long-term trends survive short-term violence, indeed. The lesson is simple but difficult. Price is not value, liquidity is not demand, and pain is not proof. You are wrong. The market will always try to convince you to abandon the stack just before it rewards it. That is not a flaw in the system. That is the corrupt system. Now, the strategy going forward is discipline. Watch the open. Respect the levels. Let confirmation come to you instead of chasing headlines. If you hold physical metal, your job is patience. If you hold fiat, your job is preparation. Volatility creates opportunity, but only for those who are emotionally steady enough to act when others truly freeze. And finally, the verdict. This crash did not weaken the bull case. It strengthened it. It reset sentiment. It reloaded shorts. It compressed the spring. It gave the next leg higher a stronger foundation. The fundamentals did not change. The debt did not disappear. The scarcity did not resolve. Only the spot moved, and it moved for reasons that expire with the calendar here. You made it through the noise. That already puts you ahead of the herd now. If this analysis helped you think clearly when the market tried to scare you, like this video, so more people can see it here, If you want calm, rational breakdowns when volatility hits, subscribe to the channel and turn on notifications today. And most importantly, share your thoughts in the comments. Press 1 if you held through the storm. Press 2 if you are preparing for the next huge move. Stay patient. Stay strategic. The next chapter of this market is just beginning here.